Welcome to another episode of Your Voice Matters. Hello, everyone, and welcome. Happy Sunday to you, and welcome to another episode of Your Voice Matters. I am your girl, Viv Cunningham, with Preferred Real Estate Brokers selling the American Dream here in Central Florida, Florida. But it is just I'm so excited to be on today. And today, this young lady that I have on, is so funny how when you go to meetings, and I tell a lot of realtors about going to meetings. When you go to meetings, the amount of people and network and referral that you get, it is remarkable. A lot of time you don't
Yeah.
understand why you go to meetings, or you know what, I'm not going to spend my money and go to meetings and I'm not getting nothing from it. But I've gotten so much referral. Majority, 95% of my business is referral. So I met this young lady and I was just talking and telling her that I did a podcast, and she said, "Well, I'd love to come on," but she was persistent, and I finally got her on and got her in the right time. But I'm just going to let her introduce herself, and I call her Miss Jackie, and I'm going to have her introduce herself and tell you a little bit about what she does and how long she's been in the business. But it has just been awesome. So welcome, Miss Jackie. We got quite a few people. We got people that are listening. We got people that are in the audience. I hope they can hear us. Hopefully they can hear us, and I don't have to worry about necessarily bringing them in the studio. So, Miss
Okay.
Jackie, go ahead and introduce yourself, and let's jump right in
All
and
right. Thank
time.
you, Viv, for having me on here. I really appreciate this opportunity. My name is Jackie Cumberbatch. I am based in Orlando, Florida. I'm a business purpose loan broker, and I focus mainly on real estate investor loans. Actually, my background is as an informatics nurse, but it's been about coming up on 2 years since I've decided to make a career change. This opportunity came up. I found a mentor and the training necessary, and so I've been doing this business ever since.
You say you were a nurse?
I am, yes, by career. I'm a registered nurse.
Isn't that amazing? I was in the medical field for many years, and this is my last stop. The
Yes.
pastor that was on last week, she was talking about you were born. When you were born, you're born to die. So go ahead and
Hmm.
start planning. So isn't
Hmm.
that amazing just to think that I was in the medical field as well, and here we are. We end up today, and you're telling me you're in the medical field, and I had no idea that you were in
And
the
I
medical
telling you too that this is my last stop as well. So
This is my last stop. And then I forgot to
yeah.
introduce my buyer's agent. My buyer's agent is Beverly. So she's in
I
she's
got
in,
you.
Hey
she's in the
Beverly.
background. So Beverly, you can say hi to Miss Jackie. And
Hi,
just
Miss Jackie.
Hi, nice to
Nice
meet you,
to meet
Beverly.
you.
Yes,
It's
same
glad to hear
here.
about your background.
yeah,
Yes.
so but that's amazing just to think. So all of us come from all walk of life in our
Hmm.
background. But I'm so
Correct.
excited that I had the opportunity to meet you at the meeting and be able to talk to you. So go ahead and finish up your conversation that you were talking about.
Yes. So my business name is Shore Foundation Consulting Services, and I am the owner and loan consultant for this business. Um, the goal of Shore Foundation, and we refer to ourselves as Shore,
Mhm.
the goal of Shore is to help you achieve your goal. And
Okay.
that would be your goal in terms of starting a real estate investment portfolio, growing a real estate investment portfolio, even some other types of loans, equipment loans. But my focus is mainly real estate. Okay. Um,
Very good.
and
Very good.
our slogan is you'll get a sure yes whenever your bank says no. So your bank tells you no, you come to us and you get a sure yes. Okay.
So why would the bank say no?
So for real estate investor loans, a lot of traditional banks have a difficult time or prefer to not lend for those loans. Now, if a person is purchasing, one property or maybe two, that's okay. But when an investor gets up to like 10 properties, for instance, even if their credit is good and everything is in place, most traditional banks will not give a loan to a real estate investor to buy the next property. Okay, so that's one reason to come to us. Another reason is that your credit score may not be where the traditional banks want it to be. But these lenders that I work with, I actually am affiliated with about 60 lenders. I'm independent, but I have
Okay.
about 60 lenders accessible to me. So these lenders, even though they do look at your credit score, they're a lot more flexible. And so their credit score requirements are significantly lower for these loans. And in addition to that, these lenders tend to close the loans faster than your conventional banks can. So when the lender, when your bank tells you no, be sure to call a sure, and you'll get a sure yes. Okay.
So why wouldn't an investor? I know you probably said that. Why wouldn't an investor go with a traditional bank just because you said after how many
10
properties? 10
properties.
properties.
Yes. If they're, if they're doing a lot of investing, a traditional bank wouldn't give them a loan for another property. Actually, I have a friend in New York who is a mortgage banker, and she actually, I was speaking with her one day, and she said, I just turned away a client. He's one of our, she's with a, she is with a credit union. She said he's one of our good clients. He's been with us for a long time, but he has hit that mark, and we just can't give him another loan.
Hmm.
So, those are the kind of reasons that traditional banks would not give you a loan for investment properties.
But you will be able to help them with that.
That is correct. I would be able to get that loan from one of my lenders.
Okay. All right. So you work with many different lenders.
Yes, I have about 60 lenders accessible to me.
Okay.
And I really use a core, a small core of lenders that I will reach out to most often. However, if something comes up that one of those lenders cannot fulfill, then I reach out to one of my other lenders.
Okay. All right.
So,
So that's good to have a network of people that you can
yeah,
actually go to. So it's not one lender that
mhm,
fits all,
that's correct.
you
That's
know. So
correct.
so
And
so
because
go ahead.
because there's so many lenders available, each lender has their own property types that they will lend on, or their own terms, and so there is opportunity for a lot of people, a lot of investors.
That's very good. Yeah, I don't work with much investor, but I do work with some. And
Hmm.
because of course they have this, they call it, I don't know what they call it, a Bible or a book or whatever they call it that they
Uh-huh.
sent you. And then these are the specs that I want. And come to think of it, I have one that sent me a whole bunch of text messages this week about
Hmm.
buying property. So it's a good thing to now. Do you work in
Hmm.
all the states in the United States, or do you work in a particular state?
So actually, I am nationwide, except for a
Okay.
few states, California, Utah, Arizona. Those are the three that I can remember right offhand. North and South Dakota. But I have cohorts that I work with.
Okay.
So if a loan should come my way that is for one of those states, then I would refer it to I would partner basically with one of my cohorts.
Okay, that's very good. That's very
Hmm.
now. What are some of the documents? To do a loan like what you're talking about? What are some of the documents and things like that? Okay, so after, let's say I went to a bank and
Hmm.
I did 10 property through them, and I'm coming to you for the 11th property.
Hmm.
What are some of the
Okay.
documents that we would need?
Okay, so let me back up a little bit and mention that for these loans, especially, so I do both investor and commercial real estate. Commercial real estate will need a little bit more, but for your typical investor loan, a single family or a duplex, triplex, quad, for those loans, there is no income verification. There are no W-2s needed. There is no tax returns needed. Bankruptcies and foreclosures are okay. Okay. So basically, what a person would need is a contract for the property that they're going to be purchasing, um, they would need to have things like the if let's say they're purchasing that property to buy and hold as a rental, they would need to have the rent, know the market rent for that property. They would need to
Mhm.
know we need to know the purchase price. I always ask for 2 months of um, bank statements. This is not to check to see if you have an income coming in there, but that this is to check to see if you have the funds that would be needed when we go to closing. So you'll need a down payment, you'll need your closing costs, your appraisal costs, so those types of things. So
Mhm.
you will also need, some lenders will require you to close in an entity. For instance, in Florida, and this is not even just the lender, this is the state of Florida, to be able to use a business purpose loan
Mhm.
for real estate in the state of Florida, you need to close in an entity. So an LLC or something of that nature, you would need to have. So in some cases, it's the state, in some cases, it's the lender that have those types of requirements. So if that borrower is in Florida, for instance, we would need their entity information, like the articles of organization and
Mhm.
that type of thing. So um, really, there's not a whole lot that's needed, at least initially. And then once that request is sent in initially, and the lender takes a look at it, they'll send me back a term sheet. And at that point, if the borrower decides to go with this product, then we will need a full application, which would require things like their insurance. We would need to know their tax information, that type of thing.
So now, on a loan like that, how
Mhm.
long does it take to close?
So these loans can range from um, anywhere from about 2 weeks to about 30 days right
Oh, okay.
now.
Wow, that's
Yes.
quick.
Yes. And I have one lender, which I haven't actually done a loan with them, but I have one lender that tells me they can close in about 10 to 12 days, as
Wow.
long as the appraisal is completed. Okay. So
Mhm.
the appraisal sometimes will take a little bit longer.
Mhm.
But as long as the appraisal is completed and all the paperwork, so this I need to be clear on. Um, it wouldn't take that time starting from when you make your initial inquiry. That time is from when you send in the actual official application. When the full application goes in,
Mhm.
that's when we're talking about. So and of course it would also depend on you getting in whatever they ask for once the application is in. And I'll speak a little bit more on that.
Right. So once all the documents are in, okay,
Mhm.
and then you review everything. So but that's when your 30 days actually start.
Yes, when everything is in. When
Okay.
everything is in, when the official application is in, you already know that they have kind of given you a conditional approval, a pre-approval, saying we're willing to give you this loan. Now submit the application. So from the time the application is in, that's the time period we're looking at, assuming that anything that they ask for after is submitted in a timely manner.
Okay, that's good. Yeah.
Mhm.
Now, go ahead. Let's talk about income and W-2s and foreclosure and bankruptcy and things like that.
hmm So these are all asset-based loans that we are that these lenders provide. And asset-based loans meaning they focus on the asset. Okay, the property is the asset. They focus less on the individual.
Mm-hmm.
Um, so, excuse me. So you don't need to have an income, because basically what they're going to do is that they're going to look at what we call a DSCR, a debt coverage service ratio. And if that, based on the value of that DSCR, they will determine whether or not this property can pay for itself. Okay, so
Okay.
basically, the way they calculate a DSCR is by taking the net operating income. This is the income, the cash flow from this property, after you've paid all your expenses. This is the revenue for the property. These are the expenses. They take the expenses away from the revenue. This is now the net operating income. They take the net operating income and they divide it by what we call the debt service, which is basically the mortgage. Okay. Um, that If that number comes out to being one or higher. Most lenders like to see that number be one or higher. If it is one, it basically means that that property is generating exactly enough income to pay the mortgage for the property, the loan that they have given you.
Mm-hmm.
Okay.
Mm-hmm.
So if it's higher than one, then it means that that property, if it's let's say um, 1.25, then it means that that property is generating 25% more than um, the actual mortgage. So that's good. That's what a lender wants to see. That basically you have the property is generating enough to cover the mortgage. Okay. So they don't need to look at whether you have an income, whether you have a W-2. They don't really need to focus on your taxes and all of that because they are focusing on the asset. Okay. This property is going to pay for itself. That's what
Mm-hmm.
is important to them. Now, bankruptcy and foreclosures, lenders vary. Many of the lenders would say, we really are not going to pay attention to that. Okay. Some lenders will say, okay, if it's been 2 or 3 years in the past, then we'll go ahead and give you the loan. So that kind of varies by lender. But yes, but many of the lenders do not focus on that.
Yeah, so I'm learning so much from this because I'm not used to dealing with the investors' loans and stuff like that. But
Hmm.
I'm gonna have to get with you, let you kind of teach me because I like to learn and I like to know about things like this because I'm used to dealing with residential loans all the time and not
Hmm.
this. So eventually, I'm gonna be tapping into you some more and let you teach me some of this stuff because some of this stuff that you're telling me is really over my head,
Okay.
because I'm not understand, but I do understand some of it. and
Hmm.
and and it's and I'm happy that I met you because I want you to be able to teach me because I should know it. I
Yes.
should know, even
Okay.
though I don't work with that many investors, just like you're talking about one, and you're talking about,
Right.
things like that. I don't know,
Mhm.
you're telling me that, but I'm just used to dealing with, okay, a loan of 3.5% down, 5% down, 20% down, or something like
Mhm.
that. I'm used
Mhm.
to dealing residential, but I'd like to learn more about that because
We'll do that. Let's get
because
together.
yeah, so I can actually work with investors and know what they're talking about when they're telling me I want a 1% cap, or I want this, or I want that. I don't know none
Mhm.
of that stuff, and it's funny. A lot of people know it, and I knew a little bit about it, but because that's not my focus. So I'm glad that
Correct. Yeah.
you're on and you're telling me, all of this stuff right now. Let's talk a little bit about
Wait, before you move on, I want to mention one thing. You actually mentioned that you work with mostly residential, and I
yes,
want to mention that it's important to understand that these loans are only investors.
right,
Now, it can be a residential property, but it cannot be a primary property. It
right,
cannot be your primary residence. So it
exactly,
can be a single family home,
right.
but it just cannot be a primary residence.
Primary, they cannot live inside of it. these are just
Mm-hmm.
these are just property for investment. That's why I said,
Mm-hmm.
I'm used to that side of it. I'm not used to the side of it where I said, they can't live in the property, and it's just for investment. That's why I said I'm gonna have to learn some more about that. I have a lot of stuff that going on. I'm going to um NAR in Washington, and I'm going to be leaving May, and then coming back on the 11th. So, but after I come back and maybe get my head situated, because I got a lot of
Yeah.
stuff going on, being in the mentee mentor program and stuff like that. I got a lot of stuff going on, but I'd like to be able to sit down and learn some more about that. How does it actually work? That's why I'm
Exactly.
glad I'm having you on to educate me, and that's why I do this podcast, because a lot of stuff that people are talking about, majority of that stuff is not stuff that I know about.
Hmm.
So
But you learn
that's
something every Sunday.
but every Sunday I learned something new. Last week Sunday was like, wow, you were born, and you got just be now that you were born, you get ready to die.
Hmm.
Because you got a plan for it.
Right.
So that kind
Right.
of resonate with me. So I'm glad that I have you on. So let's get back on what we were talking about, with the income. Now, I was going to ask the question about interest rate. Now, what kind of interest rate are these investors getting on the
Mhm.
loans?
So that is a good question, and I have to tell you, Viv, that's one of the first questions I get from every person who comes my way. Okay. Um, interest rates, there are many, many, many variables that would impact the interest rates. Okay. So, first of all, I'm going to say to you, considering that there's no income verification, no tax returns, no W 2s, they will consider you if you have a bankruptcy and even if you have a foreclosure, the interest rates are definitely higher than your um, traditional banks. However, they're lower than your hard money lenders. Okay.
Okay.
Terms are definitely better than hard money lenders as well. Terms are very flexible, but the interest rate varies. So there are a number of things that could impact the interest rates. For instance, it can be your credit score. It could be the type of property, the location of the property. It could be the lender themselves, because every lender has their own rates and all of that. Um, it could be whether or not there's a prepayment penalty, whether or not you
Mhm.
decide that you're going to go with a prepayment penalty. So there are a lot of variables. Let me give you an example. I have one here where so for a person with very good credits, 750 or greater, um, and a loan to value of 50%, which is low, meaning they give you 50%, you bring 50%. Okay.
Mhm.
You
Okay.
can get an interest rate of 7.375,
Wow.
assuming that you go with a 5-year prepayment penalty. As a matter of fact, if you go with a 5-year prepayment penalty, we can get that rate down by 0.375%. Okay. Now, for
Wow.
that same credit score, if you wanted an 80% loan to value, meaning they give you 80% of the loan, you are only bringing 20% of the loan.
Mhm.
Now, that interest rate is higher. That interest rate is now up to 8.625%. Before we said 50% loan to value, they give you 50, you bring 50, 7.375. Okay. But now at 80%, the interest rate is higher. Okay. Now, I mentioned that interest rates, not interest rate, but credit scores can be lower than the traditional banks. They'll accept lower credit scores. So, for instance, a person with a 675 credit score likely will not get a loan from the traditional bank. Okay. They
Mhm.
will get a loan from one of these lenders, but the interest rate will be higher. So, for 50% loan to value, the interest rate goes from 7.375 to 7.999. And 80% loan to value, the interest rate goes from 8.625 for a person who has 750 credit score to 9.125 for a person who has a 675 credit score. So there are a number of variables that would impact the interest rate. Actually, I have a lender who likes to say to me every time my first question also is, the interest rate when I speak with
Mhm.
her,
Mhm.
because that's what my borrowers want, right?
Right.
So she says to me, I don't sell interest rates, I sell opportunities. Basically, she is saying, if you can't get this loan anywhere else, and when you sit down and you work the numbers out in terms of, this is the cost of the property, this is what the mortgage is going to be at this particular interest rate, this is what the rent is going to be, this is how much I will cash flow. If those
Mhm.
numbers make sense to you, then that's an opportunity for you to purchase this property, right?
Okay.
In the meantime, that property is most likely appreciating in value, so you're also gaining on that end. So I tell borrowers all the time. Every time somebody come to me, I tell them, don't focus on the credits on the interest rate at this
Right.
point. Let's
Mhm.
get an intake form in. Let me send it to a few of my lenders. Let's see what they have to offer, and then let's look at the numbers to see if it makes sense.
Okay. So how
Okay.
many lenders do you send one application to?
It varies, but I would generally send to about 4 or 5 lenders.
Okay,
It
very good.
depends on it depends on what the person is looking for. It depends on the property and where they're located. Different lenders are in different states, so it depends on what the person on that particular loan situation, that
Okay,
request.
that's
Mhm.
cool. And you
So
hear,
generally about 4 to 5 lenders.
yeah.
Once I hear back from the lenders, then I put together a spreadsheet, and so that the borrower can do a side by side comparison. I send that out to them, and then they
Okay.
can make a decision on which one they want, which product they want to go with, or if they want to go with them at all.
Very good. And there's more investors that are jumping in the market. So that's why I said I'd like to learn more about this, where
Hmm.
I can help my investors better, because with me not being educated on and what they're looking for and what to do or who to send them to. And that's why I'm
Hmm.
happy that I met you, now that, I can, when people are asking me, instead of me sending them to a hard money lender that sent me the
Hmm.
information online and I don't know nothing about it, I can have you have the consultation with them and work with them. So I'm glad.
Exactly.
And it's
Hmm.
great that you work, throughout the United States, except for a few states. So that's awesome.
Yeah. Let me just add one thing. As you mentioned, throughout the United States, I also can work with foreign nationals who
Mhm.
are looking to purchase in the US. Now, I can't work with someone in the US looking to purchase um, investment property overseas, but I
Yeah.
can work with somebody overseas looking to purchase in the US.
Perfect.
Um,
Perfect.
yes. So for those clients, they likely wouldn't have a credit score because they don't have a
Right.
social. They're automatically assigned. Credit score of an A, which is a 700 credit score. Um,
Okay.
yes. So, and also foreign nationals, foreigners in the U.S. who have, instead of a social security number, they have an ITIN. It's an
I can.
independent tax ID
Hmm.
number. I could work with ITIN holders as well.
Perfect. Perfect. Yeah, that'll help me out, for people
Mhm.
who are coming over here that don't have all the cash,
Yes.
yet want to
Mhm.
purchase. Yeah.
And actually, I'm hoping to make foreign national investors my focus. So at this point, I'm kind of reaching out to a number of different organizations that will work with foreign nationals, basically.
Yeah, I got my CIPS many years back, so I do have, people that comes in, and
Hmm.
now when they come in, I normally, like, if they're coming in, I usually refer them to like Money Corp to transfer the money. So like when the
Hmm.
foreign nationals are coming in now, how does that work? Let's say it's 50%. Let's say they have 50% of the money, and
Hmm.
you're gonna research and give them 50% of the money. How does it work with them bringing the money in the United States?
Okay, so generally so first of all, I will say, and you mentioned, bringing the money into the United States, the money has to be in a bank.
Okay.
Okay. For the initial reviewing of the loan and making a decision on whether or not we will lend to them, that money can be in a foreign bank. If there's a different language, it's their responsibility to have the information translated. Okay. However, when it gets down to closing, the money needs to be in a bank that either is in the US or has an affiliate in the US. Okay, an affiliate bank in the US. I always like to say, no mattress money,
Yeah.
meaning don't come with a suitcase and tell me you are keeping the money in your mattress. The money has to be in a bank. Okay,
That's a funny one.
so.
That's a funny story, because I had a lady that actually bought a house from me a few years back, and that's where her money was. She had $80,000 underneath the mattress in her
Mm,
house.
yes, okay.
So that's a funny
Yeah, the money
story.
has to be, especially for foreign nationals. And, the reason for that is we want to eliminate or reduce the possibility of things like money laundering, for
Yes.
example.
Yes.
So, we have to be very careful with that. So, for a foreign national, once they establish that they have the money, they have the property that they're looking at, um, the process is pretty much the same. They submit an intake form to me. Um, I send it out to the lenders. We decide that, okay, this one will work. Um, Now, as far as a closing is concerned, um, they can come over to the US for a closing, or the closing can occur in a foreign country. Oftentimes, or the most preferred option would be for the closing to occur at a consulate at an embassy in their country, a US embassy in their country.
And that's a little
Um,
tricky.
yes,
Getting an
sometimes that
appointment.
can be. If for some reason they cannot get that,
Hmm.
then they can't make that work, then an apostolate can be used. And that's a
Okay.
person who is certified to close handle legal documents, to close
Okay.
mortgages and that type of thing. But the lenders generally will want to verify that there is not an embassy available for them to use, or in a reasonable time, get an appointment in a reasonable time.
Yeah.
So at that point, the monies need to be in a bank that we can
Mm-hmm.
draw from here. Now, for many foreign national loans, the lenders will require them to have some reserves, meaning the lenders may require them to have maybe 3 or 6 months of reserves. That's the amount of the rent or the amount of the mortgage, I'm sorry, for 3 to 6 months sitting in
Mm-hmm.
a bank account, because they're overseas. They want to be sure that just in case something happens, and that sometimes is required for even
Mm-hmm.
loans here in the US.
Right,
But
exactly.
just in case something happens, your tenant moves out on you or something of that nature, you don't have an income coming in. We had COVID, we dealt with COVID
Mm-hmm.
recently. So there's, depending on the lender, and the terms for that particular loan, some lenders will require you to have 3 to 6 months of reserves sitting in your bank account.
Perfect. Yeah, you're right. Some lenders require that 3 to 6 months. So yeah,
Hmm. Hmm.
let's talk a little bit about condo tell.
Okay, so perfect timing. So some of the property types that we lend on would be single family residences. We
Mm-hmm.
mentioned that already. Townhouses, condos, 2 to 4 units, condo hotels, multifamily units. Most of my lenders will do somewhere between 5 and 29 units for a multifamily, or commercial buildings. Commercial buildings can be anything from a doctor's office, an office building, a warehouse, a storage facility, an automobile repair shop, restaurant, just about any commercial building. Now, condo hotels are one of the property types that we lend on. And a condo hotel is basically, it's a condo. It's a building that has individual condos, and they're owned by individuals, versus a hotel that's owned by one person, right? So
Okay.
I can. This is a condominium. Let's say it has 100 units in there. There are 100 owners.
Mm-hmm.
Okay, each
Right.
person own a unit. Maybe some people own 2 units or whatever, but let's just say it's 100 units. There are 100 owners, so they're individual owners. However, there are some common services that are offered. For instance, there can be a registration desk. The cleaning service would be a common cleaning service that will go around and service all the units for cleaning. Now, owners might live there, or they may just come there for vacation, but at any point that they are not there, they can rent that out
Okay.
for as a short-term rental.
Mm-hmm.
So
Okay.
it's basically a condo hotel is basically a condo that operates like a hotel.
Like a hotel. Okay.
Yes, yes, they have shared services, a registration desk, maybe a security service, cleaning service, maintenance is
Mm-hmm.
done by one company. So that's basically a condo hotel. So as I was mentioning, we have the various property types that we lend on. We also do portfolio loans, meaning you can have maybe 4 or 5 single family homes that fall on the one portfolio. It's one
Okay.
owner, one portfolio, and
Mm,
that person is looking to sell that portfolio. So
okay.
somebody can come in and buy that entire portfolio of properties.
Now,
Okay.
can they buy, okay, with the portfolio of property and let's say there's five in it, can you buy
Hmm.
one or two out of it?
No, it's you're buying the entire
You've got to
portfolio.
buy the entire thing.
Yes.
Okay.
Hmm.
Now,
Hmm.
do you do mobile homes as well?
I do mobile homes, but mobile homes are a little tricky, and not necessarily tricky, but older mobile homes are y- we wouldn't find lenders for. Older mobile homes prior to June, I think it's June 15th of 1978. There was a flaw in the way the way the inside is constructed that can lead to fires. And
Mm-hmm.
so lenders do not lend on those. But if the mobile home is more recent, is newer than June 15th of 1978, then I can find lenders for that. Now, there are a couple of other things about mobile homes. Um, Lenders basically don't want their property to be mobile. They don't
Mm-hmm.
want for somebody to hitch that home to a truck and drive off. So
Mm-hmm.
the property has to be attached to the foundation.
Okay.
The land has to be owned, so it
Okay.
cannot be a mobile home on a leased lot. The
Okay.
land has to be owned. Um, they must pay taxes not as on a vehicle, but they must pay taxes as on real property. So
Mm-hmm.
they are paying real estate taxes. So those are some of the main things that would guide or determine whether or not a lender will look at a mobile home.
So when you say attach, are you talking about the mobile home is strapped down to the ground?
To the
Is
foundation, there has to be an actual foundation, and the
okay.
mobile home has to be just like your home. You're not, just a house is attached to a foundation.
Foundation. Okay.
Yes,
All
so
right.
that
So
mobile
so it
home
needs to
has
be
to be
sitting
attached.
on a foundation because some of
Yes,
these are sitting on blocks or brick and stuff like that.
yes, it cannot be just
It
sitting,
has to be sitting on a concrete foundation.
foundation. Yes,
Oh,
attached to that
that's wow,
foundation.
that's good to know. Okay.
Yes. And also, um, usually the VIN number is taken off because it's no longer considered a mobile home
Oh,
is actually a vehicle. It can be
right,
considered
right,
like a to some extent.
right.
So that needs to be gone so that it's now considered real estate. It's
Okay.
the land is owned. It's paying taxes as paying real estate taxes. So it's now real estate.
Yeah, because with us, with being a realtor, we cannot sell it unless the land is owned.
Okay.
So we can they can't even put it in the multiple listing service because just like you said, you
Mhm.
don't want somebody to come and drive off with it. That's why it's called a mobile
Exactly.
home because you can
Yes.
drive off with it, you can hitch it to something and take it away.
Mhm.
So I'm
Exactly.
glad that you're telling me that it has to be on a concrete foundation. And I
Yes.
know the land has to be owned because it cannot be in the multiple listing service unless the land is
It's
owned. So
owned.
but
And if it's in the multiple listing service, then it is most likely has to be paying tax as real property. I don't
exactly.
expect the MLS will list it if it's not
Yeah.
paying real estate taxes.
Right, exactly. Yeah, yeah, exactly. So,
Mhm.
lots of stuff to learn about that.
Yes.
But very interested. A lot of people send me a home and they might find it on a one of those big website and says, "Hey, I'd like to go take a look at this home." And then when
Hmm.
I go to the multiple listing service, it's not there and I realize, I go to the website where they had it at. It's in a mobile home park. I says, "I'm sorry, I can't sell that." You're going to have
Yeah.
to contact the person who's on that listing because they're the one that's licensed to sell that home.
Right. Okay.
So,
Awesome. Okay.
so
Something I wanted to come back to, we were talking about DSCR earlier, and I wanted to talk a little bit more about DSCR loans. So I was mentioning that, one or better, one or higher is what a lender would look for. There are some lenders who will go lower than a one,
mhm.
um, you know, as low as 0.70 when that ratio is worked out, when that number is calculated. However, the lower the DSCR ratio or number, the higher the interest rates will be. So when I was mentioning earlier, interest rates vary for a number of reasons. This is also one of the variables. If and some lenders will not do a DSCR, will not calculate a DSCR at all, but that also means that the interest rate is likely to be higher. So that's one of the variables. One other thing that I didn't mention about loans or loan types is that we also do refinances,
Okay.
bridge loans.
Oh,
Um,
okay.
yes, so if you have an investment property and you need to refinance that property, we
Mm-hmm.
can do a refinance on that.
Mm-hmm.
Um, and a couple other things to be aware of is these loans can, as far as terms go for the loans, we can have a fully amortized 30-year loan. um, I have at least one lender, I think maybe two, that will do a 40-year loan. One of them will do an interest only for the first 10 years of that loan,
Mm,
and then the
okay.
next 30 years is fully amortized 30-year. The other one will do a fully amortized 40-year loan. Okay. Also, you can get an interest only loan. Let us say, for instance, if a person is looking to do something short term, a fix and flip, for instance.
Mm-hmm.
If they're
Mm-hmm.
going to do a fix and flip, they want to purchase that property, they want to rehab that property and they want to sell that property, okay? Flip it.
Mm-hmm.
So they don't need a 30-year fully amortized loan. So lenders will offer them a short-term loan, bridge loan, 12, 24, 36 months. It just depends. And they may offer them an interest-only loan. So they're paying only the interest on that loan. Um, and then at the end of that term, there is a balloon payment by which, but the lender is assuming, and the borrower, that by that time they would have sold that property, they would have flipped that property, and so now they are able to pay off that loan, and then they can do or, well, for fix and flip they will just pay it off. If
Mm-hmm.
it's a buy and hold, for instance, and it needs rehab work, then they will buy the property, they rehab it, and then they refinance it, and that in that refinance they can do what they call a cash out refinance. So now they pay off the short term loan, and now they have the property, they can have a long term loan.
Very good. Now, for the loan, for you meeting someone nowadays, because there was COVID and things like that.
Mhm,
When you meet somebody now, if I send someone to you now, how do
mhm,
you, even though you're in a different state, how do you, what do you do? How do you do a consultation with them?
mhm. Okay, so first of all, I will, you send someone to me, I will immediately send them my intake form.
Mm-hmm.
Actually, if you should send them my digital business card, and if
Okay.
you don't have it, I will definitely get it to you.
Uh huh.
But if you should send them my digital business card, my intake form is on that card.
Oh, okay.
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 They complete that form, and once they hit the submit button, it comes into my email.
Okay.
um, that form comes in, I will review it. Most likely, I will call them to get some clarification. I want to be sure that when I'm sending this to a lender, I know exactly which lender to send it to. I want to know that I understand everything that the borrower has on that intake form. Sometimes people may write something thinking one thing, but then when I read it, it comes over as something else. So
Mm-hmm.
I would most likely call them so I could verify, you know, what it is that they're looking for. Once we have that all clear, I send it out to a few of my lenders. They take a look. Generally, within 24 hours, they will reply and let me know whether or not this is a loan they can work with. If it's a loan they can work with, they'll send me a term sheet. The term sheet would include the interest rate. The term sheet would include the actual terms, whether it's going to
Mm-hmm.
be a 12-month loan, whether it's an interest only, whether it's a 30-year. It will include all the terms for that particular loan. Once I receive that, I compile that information, send it out to the borrower. The borrower looks at it, run their own numbers, make a determination, this will work for me. I will at that point um, let the borrower know that we're going to at this move forward with now a formal application. One thing that I do before we even get the application going is I need to see two, or depending on the lender, it might be 3 months of recent bank statements. And I had mentioned this briefly before. But basically, that is to ensure that they have the funds needed for closing.
Mm-hmm.
The lender in that term sheet will tell them what the loan to value is. So if it's an 80% loan to value, they know that they have to come with 20%. So we want to see that they have the funds for closing, the lenders, the loan to their down payment, the closing cost, the appraisal cost, my fees. Some lenders have their own fees, so we want to see that they have the funds for closing, because we don't want to go through that whole process and
Mm-hmm.
then get to right before the closing time and realize that they don't really have the funds for closing. Actually, I have a cohort who had a very large loan that she was working on, and they got to the day before closing. They kept telling her, actually they sent her a bank statement that showed that they had the funds,
Mm-hmm.
but they didn't really. And they got to
What?
right before closing, yes, to realize that they did not have the funds for
Wow.
that. So we always wanted to be sure that we get the bank statements 2 to 3 months, because 2 to 3 months, you have to be able to show at least 2 to 3 months. If you send
Mhm.
one bank statement, you can have that bank statement today, and then tomorrow you spend it. So at least 2 to 3 months to see that that money has been sitting there, and it gives the lender more comfort to think that, okay, that money is going to be there until the closing. So once I get those bank statements in and we decide, okay, we're good with this, then we proceed with the application. Everything is done virtually. I will email them the application, they will complete the application. Sometimes, depending on the lender, I may send them directly to the lender's portal for them to put in the information. Most often I will gather the information from them and I will enter it into the portal. And at that point, the account executive that I'm working with will review everything to ensure they have all that they need, and they will send it to underwriting. Underwriting will then review it, and underwriting will come back with a conditional approval, meaning we approve you for this loan, but we need to see this, that, or that. And it can be different things. For instance, there was a borrower whose property was in his wife's name, but he was doing most of the work of the applying for the loan. He was basically the one applying for the loan. um, so we needed paperwork to show that between him and his wife, that was fine. He was not a renter. He needed to show that he's not a renter in that home. He's actually her spouse. um,
Mhm.
one of the conditions may be, we need to see the insurance policy, because many lenders would want their name to be on that insurance policy as well. So they need to see the insurance policy to see that their name is on that policy.
Okay.
There are a number of conditions that they may come back with, right? Once all those conditions are met, then they will go ahead to the next step. So during the time that we are working on the conditions, we're also working with a title company to do the title search, and to have everything ready for the closing.
Wow, this
Um,
is the most I've ever heard about, investment loans, and this is like, even though I've been in a real estate for 15 years, this is the first I'm hearing about all of this. It's remarkable and
yeah,
interesting
it's
to
a whole
hear.
process.
It's
Yes.
like a whole process now.
Mhm.
You were talking about closing, so you also do how do you do the closing though? You say you do mostly everything virtually.
Yes, it depends on the lender. It depends on the title company. There are a lot of title companies are using notary, the e-notary um, folks now. So, it can be done that way, or you can choose to go into the title company to close
Okay.
that loan. It varies, right? Um, so yes, so at this point though, while the conditional items are being collected, that is largely dependent on the borrower, because
Mhm.
it's their responsibility. I mean, I'm going to be on them, ensuring that I receive everything, but it's their responsibility to get that information to me, right? So something like this can delay, or can help to determine the length of time that it will take for this entire process. The faster they can get that information into me, the faster we can get the loan closed. There is also going to be an appraisal. Most lenders will require an appraisal.
Okay.
That's one of the first things we do, actually. As soon as we decide that we're moving forward with this, we get the appraisal done. Some lenders have their appraisals that they will use. Some lenders allow me to select an appraiser.
Mhm.
Either way, the borrower is the one paying for the appraisal.
Mhm.
So, depending on the lender, that fee may be included in the total closing costs, or they may have to pay it up front so that appraiser can go out and get the appraisal and get it back to us. Okay.
Yeah, there's a lot of
Um,
stuff. There's a lot of
yes, and then once we get to the closing table, papers are signed and they have their key.
They got their keys. Beverly, you're on. You got some question, Beverly, for Jackie?
Yes, I have a question here. You asked some of my questions too.
Mhm.
But what's the difference between the hard money and your kind of loan?
So,
What's the time frame?
mhm.
And
So hard money lenders they are very short term lenders. First of all, you wouldn't get a 30-year fully amortized loan from a hard money lender.
Right.
Okay. They close very quickly.
Mm-hmm.
They do, but their interest rates are significantly higher. So, it's, I always say it's up to the borrower to work the numbers out and see what works for them. If this interest rate is going to work for you and you feel like you have to close this loan in a certain period of time, then go ahead with a hard money lender. But with my lenders, you will definitely get better rates and terms from my lenders.
Because you pick the very best because you've been in it
Definitely,
long
they're
enough.
all vetted.
And
Yes, all my
it's
lenders.
great about that, that we are able to vet people and use the people
Mhm.
that really actually work and close the loans.
Yes, and these lenders that I work with, hard money lenders, for the most part, there are some companies that are hard money lenders, but for the most part, hard money lenders are individual or small organizations. But these lenders that I use are actually pretty large organizations.
Mhm.
So um, there is um, they have more ability to give better rates and terms than a hard money lender. And a hard money lender basically, I need this money right now, and they know
Yeah.
that you need it right now, and so the rates are definitely higher.
I call them loan sharks.
Mhm.
They're hard money lenders
Well,
because
somebody has to do it, and it
Mhm.
works for some people.
It
Some people that's what they
works.
need
yeah,
right away, and that's okay. And I'm glad
Yes.
that they're there.
yes.
If the
So for
numbers work, that's
Right.
that's the thing. If the numbers work for the
yeah,
borrower, then it's an opportunity for them to acquire this
like
property.
Right.
if you just purchase a property to flip, you want that money right now,
Hmm.
and you will probably finish that flip in 3 months, and you pay them back, and
Right.
Exactly.
you're
Yes.
Exactly. So that's why they're good. That's
you're
why they're good
right
there. You
away.
know.
Yeah. Now, one thing I wanted to say, for the fix and flip loans,
Mm,
very often, the time to close for fix and flips loans are usually faster than if it's a buy and hold
mhm,
type of loan, like a 30-year fully amortized loan.
yeah.
A fix, because lenders know that this deal needs to get done quickly
Mhm.
because of the urgency. Mhm.
Yes, and about how many months you would give for the flip and
Fix and flip loans are generally between about 12 months,
mm,
but some of them can be 6 months. But
okay.
generally, 12 months would be, and some lenders would say, we will give you an extension of maybe 3 to 6 months or something of that nature. However, that extension is not without a cost.
Hmm. Hmm.
Right. So, um, like, how many of your loan providers
Mhm.
would not have the penalty, payback penalty?
Mhm. So it depends on the type of loan. So for a short-term loan, like a fix and flip loan, most
Mm,
lenders will not have a prepayment penalty for that
right.
because they know you're going into it knowing that this is a short-term loan.
Mhm,
They are just going to be purchasing this property, renovating it, and selling it. So those
mhm,
do not generally have prepayment penalties. Most of the other lender or most of the loans that are longer term will
mm,
have a prepayment penalty. Now you and the prepayment penalties vary. It could be a 5-year prepayment penalty where at any point in that 5 year that you choose to pay off that loan or pay too much ahead on that loan, you're hit with that penalty.
mm,
It can be a 3-year prepayment penalty.
yeah.
It can be what we call a step down. So 5 years. The first year, within that first year, if you should pay off or prepay too much of that loan, you
Hmm.
will pay 5%. In the second year, if you should try to prepay or sell that property or refinance that loan, you
Mhm,
will pay 4%. In the
mm,
third year, 3%. In the fourth year, 2%. In the fifth year, 1%. So we call it a step down.
Step down.
yes. Yes.
Yes, and they all of those come with different interest rates.
Mm,
This is the type of thing when I say everybody asks the first question, what's the interest rate? But there are so many
yes.
variables. This
Hmm.
is a variable. It can
Mm,
be you have a prepayment penalty. Is it going to be a 5 year? Is it going to be a 5 year step down? Is it going to be a 3 year? Are you willing to pay some extra points or pay, to shorten that prepayment penalty.
Mhm.
If you shorten the prepay, if you pay down the prepayment penalty, then the interest rate, is not, can be different, right?
Mhm.
So it just depends on a number of variables. But yes, there are lenders, for the short-term loans, there will be no prepayment penalties, and there are opportunities to, either buy down the prepayment penalty, or just simply pay at closing, for that prepayment penalty. But if for somebody who is buying a property that they're going to hold, okay, or somebody who has had a property for a while and they're refinancing that property, they
Mhm.
know that they have no plans at this point to get rid of that property. Now
Right.
things can change and cause them to change their mind, but um, it makes more sense for them to go with the prepayment penalty, have the lower interest rate, because
Mhm.
as far as they know at this point in time, they do not have any plans to sell
Right.
that property in the next 5 years.
Yeah, interested. That's a lot of
Yeah, but you
good,
know,
great information.
what if you're holding this property with your loan on it now, and you get an offer you can't refuse, and you're only in the first year?
Then you will pay that
That
prepayment penalty.
prepayment penalty would be high then.
Yes, the prepayment penalty is higher in that first year.
Uh,
Yes.
so it would
Mhm.
cause you to think which one would work out
Which
better.
one? Exactly.
Yeah. Hmm.
Exactly.
So
And
that.
with real estate investment, it's all about the numbers.
Hmm.
It is all
Oh,
about
yeah,
the numbers. If
I
you run the
got
numbers and it makes more sense for you to sell
it.
that property and pay that prepayment penalty, then that's the way you go.
Hmm. Hmm.
Yeah,
Hmm.
that's why there's so many different. That's why
Yeah,
there's
it
so many
worked out
different
for you.
lenders and so
Yeah.
many different loans.
Yeah.
Yes.
We're coming
Hmm.
up on the end of our podcast, and we're about 5 minutes in. So, is there anything that we didn't ask you that you needed to tell someone out there, Jackie?
Okay, so some of the loan features that I didn't mention was, minimums and maximums.
Mm-hmm.
So most of my lenders, the minimum loan amount would be $100,000. I do have a few where they will go as low as $50,000. With
Mhm.
the recent change in
Wow.
the market, there are not as many of them that will go that low.
Mhm.
So most of them, the minimum is about 100,000. Maximum is about, depending on the lender, $10 million.
Wow.
Wow,
Okay.
Okay.
that's good
Yes,
number.
and it can be even higher on an when reviewed on an individual basis. So there are a few lenders who will go above that, but it's on a one-on-one basis.
Right, right.
Okay. What else did I not mention? I think I did mention that you can do a fix and flip, you can do a fix and hold, you
Mm-hmm.
can
Mhm.
do a cash out refinance, you can do a rates and term refinance,
Mhm.
meaning you don't want to get cash out, you just want to lower your interest rate, or change the terms. um, Bankruptcies are okay, I mentioned that. Self-employed investors are welcome. Yes, I think that's pretty much um, all. And don't let your credit score, a lower credit score, scare you off from purchasing an investment property, because I always go back to, it's about the numbers. You will likely find a lender, the interest rates may be higher, but you can make that determination on whether
Uh,
or not it works
One
for you.
other question before we close.
Okay, you got to go quick.
Suppose, yes, suppose you purchase this property with all your money. So you
Hmm.
have nothing left. You don't have
Hmm.
10%, 20%, what have you left? And you want a financing to fix this property.
Hmm.
And the property has value,
Hmm.
but only because you want to make a more
Mm-hmm.
valuable property.
Okay.
Would
So first of all, it would serve you best to, at the time of purchasing the property, determine that you need to do rehab, because many of the lenders will lend for the property as well as lend for the rehab. Some
mm,
lenders will lend, let's say loan to value can be anywhere from 60% to 85% to purchase the property, meaning you will bring 40% to 15%. But many of them in that process will also lend up to 100% for the rehab.
mm,
Okay, so if you're purchasing that property, you're better off to combine those two at the same point in
okay,
time.
I see
Okay,
what you mean.
if you don't have the funds at the time and you're now looking to get funds for a rehab, you might want to do a cash out refinance, assuming that you don't have a prepayment penalty. So you
Mm-hmm.
do a cash out refinance, you get the cash from that property, and you use it for your rehab.
Mm-hmm.
All right, that and don't go anywhere, folks. That I thank you so much, Miss Jackie. Don't go anywhere. We're going to talk off screen once I end the conversation. So I thank you guys for watching. I thank you guys for listening. And I'm just going to do some little marketing here. Don't forget about our Jerk Festival, which is coming up on June 3rd from 12 p.m. to 9 p.m. and admission is free and it's going to be in the waterfront park. So we're looking for sponsors. If you need a vendor space, we'd be happy to take your application. You can go online, jot me a thing below where I can send that information to you. If you have any questions that Jackie didn't answer, she will answer those questions for you. I'm going to be putting her contact information so you can reach out to her. But this is some great stuff. I'm going to be, she's going to be teaching me about a whole bunch of investment loans and things like that. I am looking forward to this because this was a great chat. I thank you guys for joining. You make it a great day. Have the best day of your life. You never know when it's your last. So contact me for some more information on if it's investment that you're looking for. I will direct you and I will point you to the right person because this is such great stuff. Thank you
Mm-hmm.
guys for watching. Thank you for listening.
Very
Your
informative.
voice does matter. So take care. Thank you for listening. See you on the next episode of Your Voice Matters.